Are you drowning in debt and struggling to make ends meet? With bad credit, it can feel like you're trapped in a never-ending cycle of financial stress. But fear not, because there is a solution. Credit repair and debt consolidation. In this video, we will explore the various bad credit solutions available to help you take control of your financial situation. Whether you've had a history of late payments, defaults, or even bankruptcy, there are options available to help you consolidate your debt and improve your credit score. From debt management plans to secured loans, there are strategies that can assist you in paying off your debts and rebuilding your credit. By consolidating your debt, you can simplify your financial obligations into a single monthly payment, making it easier to manage and reduce the overall interest you're paying. In addition, credit repair strategies can help you dispute errors on your credit report and improve your creditworthiness over time. Don't let bad credit stand in the way of your financial freedom. Explore the world of credit repair and debt consolidation solutions and take the first step towards a brighter, debt-free future. Understanding credit repair and debt consolidation. Credit repair and debt consolidation are two separate but related approaches to managing debt. Credit repair focuses on improving your credit score, while debt consolidation aims to simplify your debt repayment process. Understanding these concepts is crucial in finding the right solutions for your bad credit situation. Credit repair involves taking steps to fix errors and improve your creditworthiness. This can include reviewing your credit report for inaccuracies, disputing errors with credit bureaus, and implementing strategies to build positive credit history. By repairing your credit, you can increase your chances of qualifying for better loan terms and interest rates. Debt consolidation, on the other hand, involves combining multiple debts into a single loan or monthly payment. This can be done through debt consolidation loans, balance transfer credit cards, or debt management plans. The goal is to streamline your debt repayment process, potentially lower your interest rates, and make it easier to manage your finances. Understanding the differences between credit repair and debt consolidation is important because they often go hand in hand. While debt consolidation can provide immediate relief by simplifying your debt obligations, credit repair can help you in the long run by improving your creditworthiness and qualifying you for better financial opportunities. The impact of bad credit on debt consolidation options. Having bad credit can significantly impact your options for debt consolidation. Lenders and financial institutions may be hesitant to offer favorable terms or approve your application altogether. However, this doesn't mean that there are no solutions available. One of the main challenges with bad credit is that it can result in higher interest rates for debt consolidation loans or balance transfer credit cards. Lenders consider bad credit as a higher risk, and they compensate for that risk by charging higher interest rates. This can make it more difficult to save money in the long run and pay off your debts faster. Another impact of bad credit is the limited availability of options. Some lenders may not offer debt consolidation loans to individuals with bad credit or may require additional collateral or a cosigner to secure the loan. This can further complicate the process and limit your choices. However, despite these challenges, there are still debt consolidation options available for individuals with bad credit. It's important to explore these options and understand the pros and cons before making a decision. Debt consolidation strategies for individuals with bad credit. While bad credit can limit your options for debt consolidation, there are still strategies that can help you consolidate your debt and improve your financial situation. One option is a debt consolidation loan specifically designed for individuals with bad credit. These loans are typically offered by specialized lenders who are willing to work with borrowers with less than perfect credit. These loans may have higher interest rates compared to traditional loans, but they can still provide an opportunity to simplify your debt and potentially save money on interest payments. Another strategy is to explore balance transfer credit cards. These cards allow you to transfer high-interest credit card debt to a new card with a lower or 0% introductory interest rate. This can help you save money on interest payments and pay off your debt faster. However, it's important to read the terms and conditions carefully and consider any balance transfer fees or limitations. A debt management plan is another option to consider. This involves working with a credit counseling agency to create a repayment plan that fits your budget. The agency negotiates with your creditors to potentially lower interest rates and eliminate late fees. While a debt management plan is not a loan, it can help you consolidate your debt into a single monthly payment and make it more manageable. These strategies can provide relief for individuals with bad credit who are looking to consolidate their debt. However, it's important to carefully evaluate the terms and conditions, including interest rates, fees, and repayment terms, to ensure that the solution is suitable for your financial situation. Pros and cons of debt consolidation with bad credit solutions. Debt consolidation with bad credit solutions can offer both advantages and disadvantages. It's important to weigh these pros and cons before deciding which approach is right for you. One of the main advantages of debt consolidation is the simplification of your debt repayment process. Instead of juggling multiple payments and due dates, you can consolidate your debts into a single monthly payment. This can make it easier to manage your finances and reduce the risk of missing payments. Debt consolidation can also potentially lower your interest rates. By consolidating your debts, you may qualify for lower interest rates than what you were previously paying. This can save you money in the long run and help you pay off your debts faster. Another advantage is the potential improvement in your credit score. By consolidating your debt and making consistent payments, you can demonstrate responsible financial behavior, which can positively impact your credit score over time. This can open up more opportunities for better loan terms and interest rates in the future. However, there are also some potential disadvantages to consider. Debt consolidation loans or credit cards for individuals with bad credit may come with higher interest rates compared to those available to individuals with good credit. This means that you may end up paying more in interest over the life of the loan or credit card. Additionally, debt consolidation requires discipline and responsible financial management. If you fail to make payments on time or accumulate new debt while consolidating your existing debts, you may find yourself in a worse financial situation. It's important to address the root causes of your debt and develop healthy financial habits to avoid repeating the same mistakes. Alternative debt relief options for individuals with bad credit. If debt consolidation is not a viable option for you due to bad credit, there are alternative debt relief options to consider. One option is a debt settlement program. This involves negotiating with your creditors to settle your debts for less than the full amount owed. Debt settlement can be a viable option if you're struggling to make payments and have a significant amount of debt. However, it's important to be cautious as debt settlement can have negative impacts on your credit score and may have tax consequences. Another option is to work with a credit counseling agency. These agencies can provide guidance on budgeting, debt management, and financial education. They can help you develop a plan to pay off your debts and improve your financial situation. While credit counseling itself does not consolidate your debt, it can provide valuable support and resources. Bankruptcy is another alternative for individuals with overwhelming debt and bad credit. While it should be considered as a last resort, bankruptcy can provide a fresh start by eliminating or restructuring your debts. However, it's important to consult with a bankruptcy attorney to fully understand the implications and potential consequences of filing for bankruptcy. Steps to take before pursuing debt consolidation with bad credit. Before pursuing debt consolidation with bad credit, there are several steps you should take to ensure that you're making an informed decision and setting yourself up for success. First, assess your financial situation. Take stock of all your debts, including the total amount owed, interest rates, and monthly payments. This will help you determine the best approach for consolidating your debt and managing your finances. Next, review your credit report. Obtain a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, and carefully review it for any errors or inaccuracies. Disputing and correcting these errors can improve your creditworthiness and increase your chances of qualifying for better debt consolidation options. It's also important to create a budget and stick to it. Determine how much you can realistically afford to allocate towards debt repayment each month. This will help you determine the amount you can consolidate and ensure that you can make consistent payments. Research and compare debt consolidation options. Consider the interest rates, fees, and repayment terms of different lenders or credit counseling agencies. Look for reputable companies with a track record of helping individuals with bad credit. Read reviews and seek recommendations from trusted sources. Finally, develop a plan to avoid future debt. Identify the root causes of your debt and address them. This may involve cutting unnecessary expenses, increasing your income, or seeking financial counseling. Commit to responsible financial behavior and avoid accumulating new debt while working towards consolidating your existing debts. Taking these steps before pursuing debt consolidation with bad credit will help you make an informed decision and increase your chances of success. Finding reputable debt consolidation companies for bad credit solutions. When seeking debt consolidation solutions for bad credit, it's important to find reputable companies that can help you navigate the process and achieve your financial goals. Start by researching and comparing different debt consolidation companies. Look for companies with a proven track record of assisting individuals with bad credit and positive customer reviews. Check for any complaints or disciplinary actions against the company with consumer protection agencies or the Better Business Bureau. Consider the experience and qualifications of the company's staff. Look for certified credit counselors or financial advisors who can provide personalized guidance and support. Ask about their credentials and the training they have received. Inquire about the company's fees and how they are structured. Reputable companies should be transparent about their fees and provide you with a breakdown of the costs involved. Avoid companies that charge excessive upfront fees or promise unrealistic results. Ask for references or testimonials from previous clients. Hearing about other individuals' experiences can give you valuable insights into the company's reputation and the level of service they provide. Finally, trust your instincts. If something feels off or too good to be true, it's important to listen to your gut. A reputable debt consolidation company will prioritize your best interests and provide honest and transparent advice. How to rebuild credit while pursuing debt consolidation. While pursuing debt consolidation, it's important to simultaneously work on rebuilding your credit. Improving your credit score can open up more financial opportunities and result in better loan terms and interest rates in the future. One of the first steps to rebuilding your credit is making consistent and on-time payments towards your consolidated debt. This demonstrates responsible financial behavior to lenders and credit bureaus. Set up automatic payments or reminders to ensure that you never miss a payment. Reduce your credit utilization ratio by paying down your credit card balances. Aim to keep your credit card balances below 30% of your available credit limit. This shows lenders that you are using credit responsibly and can improve your credit score over time. Avoid opening new lines of credit while working towards debt consolidation. Each new credit application can result in a hard inquiry on your credit report, which can temporarily lower your credit score. Focus on managing your existing debts and improving your payment history before considering new credit. Regularly monitor your credit report for any errors or inaccuracies. Dispute and correct these errors promptly to ensure that your credit report accurately reflects your financial situation. You can request a free copy of your credit report from each of the 3 major credit bureaus once a year. Consider diversifying your credit mix. Having a mix of different types of credit, such as credit cards, installment loans, and a mortgage, can positively impact your credit score. However, only take on new credit if it aligns with your financial goals and you can manage it responsibly. Rebuilding your credit takes time and patience. Be consistent in your efforts and practice responsible financial habits. With time, you can improve your creditworthiness and create a solid foundation for your financial future. Common mistakes to avoid when consolidating debt with bad credit. When consolidating debt with bad credit, it's important to avoid common mistakes that can hinder your progress and potentially worsen your financial situation. One common mistake is not addressing the root causes of your debt. Debt consolidation alone does not solve the underlying issues that led to your financial difficulties. Take the time to understand why you accumulated debt and develop a plan to avoid repeating the same mistakes. Avoid accumulating new debt while working towards debt consolidation. It can be tempting to use credit cards or take on new loans, especially when you start to see progress in paying off your existing debts. However, this can undermine your efforts and lead to a cycle of continuous debt. Be cautious of scams or predatory lenders. Some companies may take advantage of individuals with bad credit by charging excessive fees or offering unrealistic promises. Avoid companies that require upfront payments or guarantee specific results. Do your research and choose reputable companies with a track record of helping individuals with bad credit. Don't neglect your financial education. Take the time to learn about personal finance, budgeting, and credit management. Understanding these concepts will empower you to make informed decisions and avoid common pitfalls in the future. Finally, don't be too hard on yourself. Consolidating debt and rebuilding credit is a journey that takes time and effort. Celebrate your victories, no matter how small, and stay committed to your financial goals. With perseverance and the right strategies, you can overcome bad credit and achieve financial freedom. Conclusion: taking control of your financial future with debt consolidation. Debt consolidation with bad credit solutions can be a powerful tool for taking control of your financial future. By consolidating your debt, you can simplify your financial obligations into a single monthly payment, potentially lower your interest rates, and improve your creditworthiness over time. Understanding the impact of bad credit on debt consolidation options and exploring alternative debt relief options can help you make an informed decision. Taking the necessary steps before pursuing debt consolidation, such as assessing your financial situation, reviewing your credit report, and researching reputable companies, can increase your chances of success. While pursuing debt consolidation, it's important to simultaneously work on rebuilding your credit. Making consistent and on-time payments, reducing credit card balances, and monitoring your credit report for errors can contribute to improving your credit score. Avoid common mistakes such as neglecting your financial education or accumulating new debt while consolidating your existing debts. Stay committed to your financial goals and celebrate your progress along the way.